For over a decade, Finvolution has transformed fintech in China for the better, but it has its eyes set on loftier ambitions. Just like how Amazon is an IT giant with an e-commerce exterior, Finvolution seeks to become the next IT giant with a financing exterior. But to get to that goal, Finvolution needs to look beyond just China. It needs to cement itself in new markets. I'm Ryan, and with my team, Selena, Mary, and Raymond from the University of Sydney, we will help Finvolution climb the ladder to the top of the fintech world to ultimately become the Amazon of financing. In order for this to happen, we have asked ourselves the question, how can Finvolution expand into the Southeast Asian market in the next 3 years? But to do this, it is essential that Finvolution understands where it stands currently and how it can now then fit into new markets. Let's first take a look at Finvolution's existing strengths. Finvolution has developed technological strengths that has allowed it to cement its position as a leader in fintech in China. The magic mirror model succeeds in developing a risk rating in the credit application process, and that can now be adapted for many uses. Then, the Magpie bridge facilitates the alignment between borrower and lender automatically. Network fraud detection occurs throughout the process. That is a key concern for lenders in the market, and that comes in the form of Bright Mirror. Lastly, a virtual collection agent does the loan collection processes far more efficiently than any human could possibly do. Using those highly transferable technologies, Finvolution is now able to look beyond just China. Southeast Asia, a close and very similar region, has been correctly identified as having impressive growth prospects. Taking a closer look at potential countries in South and Southeast Asia, we took a look at Indonesia, India, Singapore, Vietnam, and the Philippines. We use these 4 key metrics of population, smartphone usage, bank account and card usage, and regulations using a scale of 1 to 10, where 10 is the most favorable for Finvolution, to come up with these scores. From that, our index showed that Indonesia is the most attractive market at present, and therefore Finvolution should seek to expand there first. But it is important for Finvolution to first note that Indonesia's market will become increasingly favorable for them in the future. While smartphone usage has a mediocre 31.1% penetration, that still equates to 83.9 million users, and that number is growing rapidly. Taking a look at financing and fintech, the AFPI, or the Fintech Lending Association in Indonesia, has been established, and that has been leading the third wave in fintech regulation. It has allowed Indonesia to achieve key milestones, such as an increase in the number of registered consumptive loan providers to 49%, new licenses given out, and increased acquisitions and partnerships in the fintech space. Lastly, and most importantly, around 70% of the population is what is called the credit invisible. That means that they are credit-worthy customers, but they have no history of credit. Therefore, they are underserved by the market. With a growing middle class, Finvolution must capture the very strong opportunity here. But in order to capture that opportunity, Finvolution must understand how its business model will fit into the Indonesian landscape. Currently, the P2P model is highly prevalent in Indonesia, but that has the key risks of consumers over-leveraging themselves, high rates of returns being promised to investors, and overall high financial vulnerability. And that means we are seeing a very fortunate shift towards the B2C model, and that bodes very favorably for Finvolution. But there is currently not enough demand for modular B2B products, and that means Finvolution must not look to expand using its new focus on its B2B division. Instead, it will be able to lead the shift to B2C in China, in Indonesia, and it can then pursue its B2B opportunities when the demand arises in Indonesia. Given that way forward, to truly understand how Finvolution can become the Amazon of financing, it must compare its success in China to see how that would fare in Indonesia. We identify 3 key learnings from our analysis. Firstly, Chinese consumers initially favored convenience, and then they preferred price after the industry settled down a little. We don't believe that this will be the case in Indonesia due to its lower disposable income. Secondly, the rapid changing of regulation in China meant that Finvolution had to adapt very quickly in the space of 2 to 3 year periods. And we believe that now they have future-proofed their business model so they can succeed in the future, even if regulations do change. Thirdly, Indonesia has a very unique market, and that means that growth is driven by collaboration. Finvolution must note these key learnings to ensure that it expands into Indonesia successfully. So how exactly does it do that? I'll pass it on now to Selena, who will explain.
Thank you, Ryan. Our strategy to enter Indonesia will come in 3 stages, or 3 Cs, which we've called Create, Capture, and Consolidate. I'll start off with Create, which discusses how we'll set up Finvolution's business model in Indonesia. So we noted some key similarities and differences earlier between the Chinese and the Indonesian market, which had led us to adopt a similar business model when entering Indonesia, but with variations in staging in order to best adapt to the unique business environment there. Primarily, we will not be using Finvolution's early stage peer-to-peer model due to it being limited by the amount of capital individual investors can provide and also its difficulty for scalability. Instead, we've decided to focus on the Fintech services B2C branch of the Finvolution model first, by partnering with small and medium-sized financial institutions to provide loans, which will allow us to eventually establish ourselves in B2B fintech empowerment as well. Now, 3 main considerations guided us in making this decision. Firstly, culture. A McKinsey report found that Indonesian consumers were increasingly open to digital payments, more so than any other emerging Asian market. Secondly, customer base. The rise of Indonesia's middle class and the associated increase in phone penetration rates will allow for our expansion to become the Amazon of financing. And thirdly, IT offerings. Finvolution should leverage its competitive advantage in AI and machine learning to ensure that it assumes the dominant fintech position from the beginning. Now, how did we select these financial institutions which we would decide to partner with? We chose 5 main criteria. Firstly, reputation, how trustworthy the bank was in the eyes of its consumers, its online capacity, how the bank currently uses online banking, its current users, so the demographics of the bank's current user base, and whether we could add value to the bank by bringing in younger customers. Fourth, regulation. How favorable is the bank's operations when concerned with regulatory bodies and the government? And finally, cooperation. How willing would the bank be to work with us as a newer fintech startup? 3 examples of banks that fit all of these criteria for us were selected: Bank Danamon, Panin Bank, and Bank BTPN. These are all examples of medium-sized banks in Indonesia, also chosen for their propensity and their work with micro, small, and medium-sized enterprises. Let's move on to the second prong of our strategy, capture. We first have to acknowledge that Finvolution operates as an intermediary in a 2-sided marketplace, which does mean that they are faced with the problem of capturing and bringing on board both financial institutions and individual customers. So the first, financial institutions, will be attracted through our tailored IT offerings, as well as our ability to capture parts of the market which have previously been less accessible to them, such as the credit invisible, people who may not have had a previous credit rating, and a younger demographic of Indonesians. We'll also later be discussing how to acquire and retain individual customers as borrowers through multiple channels. So looking first at the lender side of things, we found that Finvolution's competitive advantage is its technology for risk management. Considering that lenders require significant assurance of a return and that their funds will be repaid to get on board, we found that this initially might have to take the form of a higher lending rate. But we also have confidence in Finvolution's advanced artificial intelligence and their machine learning technologies in the form of their risk assessment algorithm, Magic Mirror, and their anti-fraud mechanism, Bright Mirror. We would instead be looking to develop additional algorithms through these 2 systems for credit invisible consumers. This would mean inputting extra data to make assessments on top of the already required financial and employment data, such as job stability, predicted income security, marital and dependent status, or existing assets. All of these additional measures are put in place for lender confidence, for us to manage risk, and to avoid fraud. Obviously, we want to mitigate fraud and risk, which is why we've increased these data requirements, especially for those without a credit rating. This would be made up of existing control models with inputs such as personal data and existing liabilities to determine things like income security, but would also give customers the ability to opt in, to provide additional information such as their telecom data or call and message logs, or even previous tax filings to give a more complete financial picture. Ultimately, the takeaway here is that users can choose to provide information for a faster application process result or the possibility of a better credit rating by the algorithm. I'll now pass on to Mary, who'll discuss the second side of our marketplace, the customers.
Thanks, Selena. Now that Selena has discussed how we will win the financial institution side of the two-sided market that is the fintech sector, we'll now move on to the customer side. In order to capture loan customers, Finvolution must first attract the business of young and working-aged Indonesians, who comprise the majority of the Indonesian population. Younger Indonesians are favourable to Finvolution's business proposition in four main ways: their high smartphone ownership rates and internet accessibility, frequent demand for loans due to the dynamic nature of their lifestyles, and social media presence. As such, Finvolution must enter the Indonesian market by targeting this group. In order to do so, Finvolution must leverage key channels as consumer touchpoints, similarly to their existing strategy in China. YouTube, Instagram, and TikTok are three of Indonesia's largest social media entities, and by advertising Finvolution on these platforms, as well as on the most used search engine Google, Finvolution can situate itself in the minds of Indonesian consumers. Furthermore, through broadened accessibility on both the Vivo and Google Play Store platforms, Finvolution will be accessible to the majority of Indonesian people, with Vivo being the top-selling smartphone brand in Indonesia. Finally, customer referrals will prove a constant source of customer acquisition, as individuals use the product offering, are satisfied, and then communicate this satisfaction to those around them, particularly other young people in the target demographic. As something as sensitive as personal finances requires trust, we view referrals as a primary source of customer growth, as individuals value and trust the opinions of their peers. Ultimately, we see online advertising, referrals, and the necessity in a younger demographic for non-bank loans as allowing Finvolution to acquire more customers. Finvolution must then consolidate this presence by cultivating a positive customer experience. This will be achieved by creating a simple user interface which enables individuals who often have not had previous experience in the banking sector to understand the process of acquiring a loan with a high degree of transparency. Speed of usage and financing, along with a domestic customer helpline, will also entrench the convenience and user-friendliness of the Finvolution platform. Customer retention will also be fostered through the offering of improved rates for long-term customers, given Magic Mirror is able to better generate data about credit history for such users. As is evident through this mock-up of the Indonesian iteration of the Finvolution app, by transparently stepping through each stage and the various aspects of the loan process, Finvolution's offering is user-friendly. Fostering this positive customer experience will promote retention and referrals, as individuals who feel that they have engaged positively with Finvolution will proceed to becoming long-term users, referring others onto the platform, and thus generating a broader network of users. Customer acquisition and retention will also be a key driver of success, as having more customers on the Finvolution platform will mean that banks are more incentivized to join. With a larger network of third-party financial institutions and customers, Finvolution will undergo an Amazon-like expansion and become the fintech market leader in Indonesia. As this expansion accelerates, Finvolution will gradually connect with the unbanked population of Indonesia through the network effect generated as the company reaches scale domestically, and also as smartphone penetration rates increase. This will ultimately allow Finvolution to tap into and generate valuable connections with the Indonesian community at large. Raymond will now step us through the impacts of our strategies.
Thank you, Mary. Let's look at the implementation, financials, and risks of our 3Cs. Our first strategy, Create, focuses on forging partnerships with financial institutions as well as connecting with our Indonesian customers. In the lead up to this, Finvolution will need to adjust some elements of their magic mirror to cater for Indonesian audiences, such as recognizing different forms of ID. The company must begin negotiating with financial institutions to onboard them as secure lines of credit for our users. Once we complete these negotiations, we can begin aggressive marketing campaigns using both traditional forms of marketing, but also critically the internet. This completes our create process. Finvolution should then execute the capture part of our strategy. Its rising middle class has been underpinned by Indonesia's growing young urban population, who also possess high propensities for discretionary spending to improve their livelihoods. Large cities such as Jakarta, Surabaya, and Padang will be amongst the first cities where Finvolution will launch. We propose firstly targeting individuals in these areas, as these people have high volumes of transactions and will be in need of personal credit. We then want to make sure that customers stay and recommend Finvolution to others. This is where Consolidate comes in. We believe that a simple interface and AI-enabled capabilities will not only get customers credit faster, but also give them access to more competitive rates. And with Karma, more financial institutions will see this proof of concept and be willing to partner with us. This allows the company to facilitate larger credit lines for SMEs who also offer Finvolution lower risk. Finally, after being in urban areas, we believe that Finvolution should expand into the unbanked rural areas, and we think the network effect will come into play for the company as economic migrants bring the movement to these underserved areas. Looking forward, we foresee an entry to other Southeast Asian countries to be plausible for the company. We specifically targeted Vietnam, Malaysia, and the Philippines, as we believe these countries to be underserved by traditional banks. They're a few years removed from having the same fertile conditions as Indonesia. Because the country is a regional superpower, we believe that establishing ourselves in Indonesia first gives Finvolution a strong foothold in the region. But let's focus on Indonesia. Firstly, increasing internet penetration and mobile ownership will pave the way for Finvolution to be more accessible to the population. The increase of bank accounts and debit card ownership will lower the credit risk of our Indonesian audience. And finally, the increased need for short-term credit and small-scale service loans provides the void that Finvolution will fill. Organically, we believe at the end of 3 years, Finvolution will have 40 million Indonesian users due to the combination of these factors. The company's variable costs will be the greatest costs when expanding into Indonesia. Each new user incurs both a servicing cost as well as some provision to mitigate against their risk factor. With the guidance of an upper end of guidance, we've reduced the variable cost for each new user to be $2,000. We took a fixed cost based on historical figures and believe these to be appropriate for Finvolution, as digital solutions are more affordable whilst addressing a larger audience base. With the upper end of guidance, we believe our strategy is to be affordable, actionable, and achievable within the timeframe we have proposed. There are two risk categories post the Finvolution when entering the Indonesian market. Structurally, regulatory changes may impede the firm's operating capabilities, but given it is one of the first players in the market, regulatory changes may also impose barriers to entry that hedge against competition. Persistently low interest rates may make credit from banks seem enticing. However, inflationary pressure may see these rates increase sooner than expected. Cultural factors may cause some friction for a foreign company when entering a new market, and thus Finvolution must consider the cultural differences between China and Indonesia. 3 firm-specific risks stem from their institutional partners. The reluctance of institutions to partner with Finvolution may inhibit the company's operating capabilities. This also imposes a liquidity risk, as the firm may not be able to extend its line of credit and thus be rejecting many unhappy customers. Finally, if Finvolution needs to gain the support from one of its Chinese institutions, that may incur a forex risk. We foresee the company's strong AI capabilities and anti-fraud measures to protect against these security risks and offer Finvolution a strong moat to operate in Indonesia. Today, you've asked us, how can Finvolution expand into the Southeast Asian market in the next 3 years? We've responded with 3 prongs for our market entry into Indonesia: create, capture, and consolidate, that not only proliferate credit to the masses, but also cement the company as a titan in the fintech space. The overcoat of our 3 Cs will transform lending in Southeast Asia and propel Finvolution to be the Amazon of finance. I now open the floor to questions.
Thank you very much for the presentation. It's now time for the Q&A session. The 15 minutes countdown will start. 15 will start now. Let's hear the first question, please. Thank you.
Thank you, team. It's a great presentation. I like the storyline that you divide them into 3 different stages: create, capture, and consolidate, which is easier for us to understand where you're going at. Can I ask a quick question on the revenue model? Do you have a rough idea of what is the primary stream of revenue, and when can we break even from a Finvolution perspective?
Yep, sure. So there's 2 main streams of revenue, and that comes from its fees in terms of servicing, as well as interest income from the loans that are gathered from these, from the lending that occurs when the borrowers take money out from Finvolution. And we believe by the end of 3 years, Finvolution will be able to turn a profit, as these 40 million users will generate a profit of upwards of 1.2 billion US dollars in the Indonesian market alone.
Okay.
In terms of partnership with the lenders, what form of partnership have you considered, and can you explain why?
Yeah, happy to take that question. Thank you. So essentially, what we're looking at with our lenders is an institutional to peer lending model, which means these financial institutions would be contributing their capital, which would then go through us as an intermediary and then be lent out to our individual borrowers, who would be, your average Indonesian person. The reason we chose this instead of peer-to-peer lending is that we saw, firstly, the industry as a whole was moving from peer-to-peer to a much more institutional to peer sort of model. And that, move away from sort of community-driven funding was that primarily due to, firstly, the kind of amount of capital that was available with institutional investors. And secondly, we thought that in China, we saw that peer-to-peer had to be regulated out due to its fundamental flaws. And we know that in Indonesia, even though peer-to-peer is currently quite popular, it's a, slow bureaucratic process. And we saw that ultimately we were future-proofing our business by kind of getting ahead and going straight to the institutional model. And so in short, essentially, we thought, firstly, banks would work with us and we would be the intermediary. And secondary, this would be more favorable in a regulatory environment.
Thank you. Just to touch upon your commercial and the revenue model, etc. By when will this break even? And the timelines which you showed in one of the slides, does it not seem as if it's too slow-paced one from year 0 slowly to year 4?
Yeah, so we project the company to break even at the start of year 3. So this is approximately when it would onboard around 28 million Indonesian users. And we think that with increasing internet penetration, mobile ownership, as well as the need to facilitate smaller and shorter loans, that a 3-year time span actually offers a very fertile market for Finvolution to grow at the pace at which we propose that. And we see that Finvolution's growth in China, especially under changing regulatory environments, has been very quick. They've been able to adapt very rapidly to these environmental changes. And we think that 3 years is a comfortable time for the company to expand in Indonesia and then consider regional outwards expansion.
Maybe a follow-up from there. Understand your need to partner for a B2B or not going from a crowdfunding option. But if you look at the learnings of Finvolution in China, where they started as an e-commerce platform, acquired the customers, and then moved on to become a lending platform, why would you directly go with a partnership with a bank or a lending arm? And if you do so, and they lend you the capital and the funds, then they would have a share of your revenue too, including your interest income. So how would you look at the revenue sharing and the impact on your P&L, and why would you not leverage upon the China model, which is going through a different path to where they end up in, vis-a-vis the path they've chosen in Indonesia?
Yep, I'm happy to take this question. So I'll answer your question in two parts, but essentially the high-level overview as that is that the position that Indonesia is currently in, which is the P2P model, is where China was a few years ago. And that ultimately failed and required regulation to take it to the B2C model, or the institutional to peer model. And so the first part of answering this is looking exactly why China's model didn't really work with the P2P model. I think that's for three reasons. Firstly, we saw a lot of like Ponzi schemes, for example, and that really threatened the trust in the industry. Secondly, because it was a P2P model, peer-to-peer model, that meant that a lot of consumers were over leveraging themselves, and it meant that they couldn't pay themselves back. And lastly, when you were investing in the fintech space, there were like really high rates of return being promised to investors. And when that didn't work out, that meant that there were large bank runs and huge liquidity risks. So we don't believe that the learnings from China, or like the learnings we essentially take from China, are that we shouldn't pursue this P2P model. Instead, what we propose is the B2C model, which is the second half of how I'll answer this question. The B2C model essentially means that we partner with financial institutions who are able to provide those loans. So they are the lenders, and we then get the customers on board, and then we align them as like the fintech model works in Indonesia and in China. So that's how we believe this model will precisely work.
If I may just do a follow-up on that, whose customers are they then? Are the underlying bank's customer you're partnering with, or are they Finvolution customer? Because end of the day, it's a bank's balance sheet you're leveraging upon.
Yep. So these customers are Finvolution's customers. They align onto the Finvolution app. Then Finvolution matches them to the lender using the alignment process in the Magpie bridge. The way in which we agree for the banks to partner is with everything that Selena said, but the prime driver of that is the fact that now opens the banks to far more people and far more customers. And if they can't pay their debts back, then we will ensure that money somehow makes it back to the bank. And by creating that, locking that in for the banks and locking in far more users than they currently would, that's how we believe that banks will actually make money.
Thank you.
Can I ask a question from a data perspective? So I think one of the key success factors for this model to work is the use of data and the diversity of data. For example, you mentioned that you will develop new algorithm to support the credit-worthy community, and then there will be two sources of data you're having. For example, you are using the risk control model to collect personal data, etc. And then you have additional area to crowdsource all the additional data like telecoms data and tax filing data, etc. So, for example, if I'm a customer in Indonesia, then what is the confidence you are giving me to provide my personal data to you against the other larger firms like a larger bank or large firm like Amazon? Is there any approach to position your firm to conquer the question?
Happy to take that question. So let me answer your question in two ways. Firstly, just looking at how exactly the customers, would be giving us their data, and secondly, why they would want us to give us their data. So firstly, just how they're giving us our data. Like I mentioned earlier, essentially it would be kind of partially mandatory and partially opt-in system, which is the model that they operate under in China right now. What this means is that the mandatory information would be pretty much everything you would be required to give to a bank when applying for a loan anyways. Things like, your income, your job, personal data, things like that. And we would see that given people are applying for a loan, they should expect, some level of personal data to have to be given up to the system. The second part is the opt-in. And so that's perhaps things that not everyone will want to give, like their telecom data or their tax filings. But the advantage of giving that would mean that they perhaps, the system gets a better financial picture of that person and is able to give them a faster loan application result. Moving on to the second part of the question, why they would want to give us our data. Essentially, we saw that in China, customers had I believe it was 98.5% satisfaction rate with their experience with Finvolution's AI. And we saw that Finvolution really had its strength in its ability to leverage AI to make that, super trustworthy to customers and make that a system that customers would want to use. But on top of that, we saw that customers, were often likely to try and get small loans. So anything from, in China at least, 1,000 to 50,000 yuan, which is roughly 200 to 10,000 USD, give or take. And we saw that these small loans were sometimes not facilitated by banks, especially banks who would turn you away if you didn't have a credit rating. And so customers were more likely to come to us and say, we'll give you this data if you can do what a bank cannot do for me. And that was our value add there.
Very good. Thank you. Can I ask one more question from a future perspective? So I know that you have a long-term plans on the future market expansion, etc. So do you see your position of the firm being the market leader across the region, or are you going to position yourself to be a service provider to sell your data to the other industry players? What is the longer-term vision of the firm?
We believe that becoming a regional superpower in the market is ideal. We think that if we sell off data, this imposes revenue sharing models that may be unsustainable and prone to risks such as fraud and laundering in the Southeast Asian companies. Hence, keeping everything in-house allows us to securitize the data in the way that we want to. And like I've said before, the regulatory environments in Malaysia, Vietnam, and Philippines aren't as accommodating as Indonesia right now. And with the third highest population in Southeast Asia, we think that Indonesia is a very fertile market to establish ourselves there.
Okay. Can I have a follow-up question on that as well? Right? So I know the mission statement of the firm is to be the financial version of Amazon. So in the longer term, like 3 to 5 years after you break even, do you see Amazon as a competitors, or are you going to be, what's the differentiating factor against yourself from Amazon? If I'm a customer, why should I pick you instead of picking Amazon if they're going to the finance world?
Well, essentially, we see Amazon right now as the bellwether with all these bells and functions that facilitate better kind of logistics and facilitation of e-commerce. And we don't think that this necessarily intersects with our fintech business model. And we believe that even though there may be some artificially kind of mandated competition, we don't think that it poses such a risk to Finvolution just because it's in an inherently different kind of market, and that these customers who need loans would then go to Amazon to buy whatever they need as well. So the existence of Finvolution is complementary to Amazon in the Southeast Asian market.
Thank you. Maybe just a follow-up from the discussion so far. Finvolution is not the only company assessing the opportunities of entering Indonesia, and there are already quite a few fintech. It's quite a crowded market right now. So in the fintech lending space, what is the right to win for Finvolution, given that it's A, already a crowded market, B, it's an attractive market for not only Finvolution, but quite a few other players who might be planning the same strategy?
Yeah, I'll speak to that one. So essentially, when we did like a brief competitive analysis of the fintechs that already existed in Indonesia, we saw that there were a couple, but the main players in the market were mostly peer-to-peer lending. And this was another reason why we chose the institutional to peer model. So if I might give a few examples, Coinworks or Credivo, Amartha, all of those were focused on, community lending, and they had much lower active users because of that. With our institutional model, we see that it's much easier to scale. And so it's much easier for us to come into the market and to grow ourselves and to expand, especially given the second thing I wanted to mention was that Finvolution has its competitive advantage in its customer experience and its strength of its IT, which we don't see, something that complex in most of the other fintechs established in Indonesia currently. And so for us, it's much easier to come out on top with our reputation, our IT, and overall just our kind of different business model.
Thank you. Just intrigued to understand a bit more about one of the rationale for choosing Indonesia over others, and it did touch upon amongst the risks also the same factor of regulatory risks. The first thing you mentioned is regulatory changes and risks. On the other hand, the reason why you're entering Indonesia is because of currently the low level of regulatory restrictions compared to the other markets like Philippines, etc. Aren't these two in a way contradictory? Because the regulatory landscape can change very, very fast. Therefore, instead of relying upon a low regulatory restrictions, why wouldn't you focus upon trying to overcome the highest regulatory bar? Then you can find a right to win in any other market across in Southeast Asia or anywhere in the world.
I'm very sorry. I have to interrupt here because the time's out. So unfortunately, we will not have time to allow the team to answer this question. So the team, thank you very much for your presentation. Thank you very much, judges. The team will place you back in a waiting room for about 8 minutes, so the judges can have some time to deliberate. Thank you.
Thank you, team.
All the best.
Well done.
Thank you.
Thank you.